Usually when you look at a company's stock chart, you expect some kind of underlying logic.
Right, yeah. You want to see a story that makes sense.
Exactly. Like you anticipate a steady climb on consistent earnings, or maybe a gradual decline during a market pullback, or even like a sharp drop when bad news hits the wire.
Sure, because a chart is supposed to reflect physical economic reality.
Right. But then, every once in a while, you encounter a stock that just resembles a completely broken, wildly erratic EKG machine.
Oh, those are the ones that really make you do a double take.
Totally. And I mean, today we're talking about a company that has surged nearly 493% over the past 52 weeks.
Which is massive.
Massive. But then it's suddenly cratered by almost 50% from its absolute high. And then, seemingly out of nowhere, it just exploded for a 72% gain in, like, just the last 5 days.
Wow. Yeah, that just defies every clean, rational expectation investors try to project onto the market.
It really does.
That kind of volatility, it usually suggests a complete disconnect between the narrative that investors are buying into and the actual business being operated.
Which is the exact mission of our deep dive today. We are looking at a company called Applied Optoelectronics.
A very interesting one right now.
Yeah, and we need to look past this extreme, honestly almost deafening market noise to understand the physical reality driving it. Because the ultimate question for you, the listener, is whether we are witnessing the birth of a sustainable infrastructure giant, or if this is just a volatile, highly speculative hype cycle that's, destined to collapse.
And that distinction is incredibly pressing. I mean, the AI narrative is dominating literally every headline right now.
Oh, you can't escape it.
Right. But those headlines are often totally divorced from the mechanical, physical constraints that actually make artificial intelligence possible in the first place.
That is such a good point. If you've been following the AI gold rush, you hear the exact same buzzwords on repeat. Software, algorithms, large language models, and of course the GPUs.
Always the GPUs.
Always. But today, we are stepping away from the software and the microchips to look at the literal optic nerves making it all work, the physical fiber optic connections.
Because to understand why a stock whipsaws 72% in a single week, you have to first dissect the underlying business that's whipping the market into this frenzy.
Okay, let's unpack this. What does Applied Optoelectronics actually do?
So fundamentally, they manufacture optical transceivers. And currently, their entire focus is on next-generation 800G and 1.6T transceivers.
And those are built specifically for AI data center infrastructure, right?
Exactly. That is their core target market right now.
Let's make that tangible for a second for the listener.
Yeah.
If you compare a massive AI data center to a human brain, the GPUs, those chips everyone is constantly talking about, they are the individual brain cells do the actual thinking and processing.
I like that analogy, yeah.
Right. So Applied Optoelectronics is building the optic nerves. A transceiver is essentially a high-speed translator. It takes electrical data from those digital brain cells, converts it into physical pulses of light, shoots that light down a fiber optic cable, and then translates it back into electrical data on the other side.
And that translation process is where the true engineering marvel lies. I mean, when we say 800G and 1.6T, we are talking about gigabits and terabits of data per second.
Which is just an unfathomable amount of information.
It is. And hyperscalers, the massive tech behemoths running these cloud networks, they are training AI models that require mountains of data to move instantaneously.
Right, because if it lags, the whole system just drags.
Precisely. If those brain cells cannot talk to each other fast enough, the entire supercomputer bottlenecks. It slows down. So the desperation to avoid that bottleneck is driving this really aggressive, broad-based demand surge across the company's data center business.
And that desperation, it's incredibly obvious when you look at the financials. I mean, the top-line numbers are an absolute rocket ship.
Oh, the growth is staggering.
Just on a trailing 12-month basis, their revenue is up 64.32% year over year. And to put that acceleration into perspective, the fourth quarter 2025 was the strongest year in the company's entire history, coming in at $134.3 million.
A record-breaking quarter for them.
Yeah, but then the second quarter of 2026 just posted nearly $191.9 million.
So you were looking at massive sequential and year-over-year growth there. And crucially, with that most recent Q2 report, they managed to mark a return to non-GAAP profitability.
Which is a huge milestone for a company scaling this fast.
It is. They are basically proving that as the top-line revenue explodes, they can actually extract a profit profit from those specific operational quarters. Well, at least when you strip out certain accounting variables.
Okay, that distinction between GAAP and non-GAAP brings us to a massive glaring contradiction in the data here.
Let's hear it.
You just noted they squeezed out a non-GAAP profit. But if demand is truly astronomical, and hyperscalers are just throwing money at them, driving a 64% revenue surge, why is the company's trailing 12-month net margin actually negative 8.55%?
That's a great question.
And their trailing earnings per share is negative 66 cents. I mean, a massive revenue boom of this magnitude should translate into a massive, undeniable profit boom.
You would think so, right? But the friction between those soaring revenues and negative trailing margins comes down to the physical limits of their manufacturing pipeline.
Okay, what kind of limits?
Well, the company's chief financial officer actually had to publicly flag a critical supply chain issue. They are suffering from what they call a laser bottleneck.
Wait, a laser bottleneck? So their biggest problem isn't finding customers, it's actually finding the physical parts to build their own product.
Exactly. It's a supply constraint.
But if these hyperscalers have basically infinite money right now,
Yeah.
why can't Applied Optoelectronics just buy their way out of this bottleneck? Like, if you need parts and you have massive purchase orders from the biggest tech companies in the world, why can't you just pay a premium to source these lasers from someone else?
Because the global infrastructure to build them simply doesn't exist at the scale AI requires right now.
Wally, it's just not there.
It's not. To create those light pulses inside the transceiver, you need highly specialized indium phosphide laser.
Indium phosphide. Okay.
Yeah, and indium phosphide isn't like stamping out plastic or, even standard silicon. It is an incredibly complex compound semiconductor material.
So it's just fundamentally harder to make.
Much harder. Manufacturing these lasers requires atomic level precision, and the yield rates, which is the percentage of lasers that actually function perfectly off the manufacturing line, they're notoriously difficult to stabilize.
So they're throwing away a lot of duds, basically.
Exactly. So even with almost infinite demand for these 800G and 1.6T optics, severe supply-side constraints on indium phosphide lasers are capping what Applied Optoelectronics can actually assemble and sell.
Wow, so they are quite literally capped by physics and material science right now.
Yep, they are.
That seems like an incredibly dangerous position to be in when you consider the competitive landscape.
Yeah.
I mean, they have well-capitalized rivals like Lumentum, who are constantly hunting for market share.
Oh, Lumentum is watching this very closely.
Right, so if Applied Optoelectronics is paralyzed by an indium phosphide bottleneck, won't the hyperscalers just cancel their orders and pivot to Lumentum?
That is the exact existential threat hanging over the company right now. Because Lumentum isn't just a competitor, they are an innovator pushing a completely different technological approach.
Right, the EML technology.
Yes, EML, or externally modulated lasers.
I really want to break down why that matters mechanically for the listener. Because from my understanding, a traditional laser turns on and off billions of times a second to create the light pulses, which causes a lot of thermal stress and limits the speed.
That's right. It's a very stressful process for the component.
But Lumentum's EML technology acts more like a flashlight that just stays on constantly, while an incredibly fast microscopic shutter blinks in front of it to send the signal.
That is a brilliant way to visualize it, yeah.
Yeah.
Because the laser itself isn't constantly switching on and off. The EML approach can achieve higher speeds with much better signal integrity over longer distances.
So it's just a superior way to handle that massive data load.
And it is a completely different manufacturing process. So while Applied Optoelectronics is struggling to source enough direct modulated indium phosphide lasers, Lumentum might bypass that specific supply bottleneck entirely.
Oh, wow. So they could just sweep in while Applied Optoelectronics is stuck waiting for parts.
Exactly. Applied Optoelectronics is in a race against time to solve their supply chain before their competitors render their technology second tier.
Which totally explains their primary mitigation strategy.
Yeah.
I mean, if you can't buy the lasers you need because the global supply chain is tapped out, you just have to build them yourself.
That's the only option left on the table.
And that's what they're doing. Applied Optoelectronics is executing a massive capacity expansion at their Pearland manufacturing campus in Texas.
A huge undertaking.
Yeah, and when you look at their cash flow, you notice they aren't initiating stock buybacks. They aren't paying dividends to shareholders. Every available dollar of capital is being aggressively redirected into this physical factory build-out so they can scale up in-house production of these specific lasers.
But the execution risk there is astronomical. I mean, building a high-tech manufacturing facility to produce sensitive compound semiconductors at scale is a monumental engineering challenge.
It's not just throwing up a warehouse.
Not at all. It takes time, regulatory approvals, and extreme precision. If they hit yield issues on the new assembly lines, or even just basic construction delays, that 64% revenue growth will hit a brick wall, all while they are burning millions of dollars in cash just to keep the factory lights on.
Okay, so this brings us to the most pressing mystery of this entire analysis.
Let's get into it.
We have established very real, very stubborn physical bottlenecks. We have a highly aggressive competitive threat from Lumentum's EML technology.
Yep.
We have negative trailing net margins and massive execution risk in Texas. Knowing all of that, what on earth caused this stock to suddenly violently spike 72% in just 5 days?
Because the catalyst actually came from entirely outside the company's own operations. A major regulatory tailwind hit the news cycle.
What was it?
A proposed government ban on Chinese AI hardware.
Okay, to be explicitly clear for the listener here, we are not taking a political stance on international trade policy or the ethics of tariffs in this deep dive. We are strictly examining how this legislative proposal acts as an economic catalyst for the stock market.
Absolutely. And purely from a market mechanics perspective, the implications are pretty straightforward.
How so?
Well, if the massive cloud providers are suddenly restricted by law from buying AI, hardware, transceivers, or components manufactured in China, they will be forced to drastically increase their domestic sourcing.
You have to buy American.
Right. And that anticipation sent a shockwave through the market, instantly boosting domestic fiber optic names across the board. The market is suddenly pricing in a scenario where Applied Optoelectronics is handed an even larger guaranteed share of the data center pie simply by virtue of having a manufacturing campus in Texas.
Okay, but here's where it gets really interesting. You would naturally assume a geopolitical ban forcing domestic buying would trigger a massive volume of trades, like everyone rushing the door at once to get a piece of the action.
That's usually what you'd expect.
Right. But when you look at the technical trading tape for that 5-day period, the reality shows the exact opposite. The trading volume during this explosive 72% move was actually sitting below the 3-month average.
Which is wild to think about.
It was at 0.88x relative to its normal volume. How does a stock jump 72% when fewer shares are actually trading hands than on a normal Tuesday?
Because you are looking at the mechanics of a liquidity squeeze.
A liquidity squeeze?
Yeah. A massive price surge isn't always driven by a tidal wave of new buyers flooding the market. Sometimes it is caused by a complete evaporation of sellers.
Think of it like a housing market in a highly desirable neighborhood where absolutely nobody has put a for sale sign on their lawn.
Right. Nobody wants to sell.
And if even 2 or 3 desperate buyers want to move into that neighborhood, they end up getting into a massive escalating bidding war over the one single person who might consider moving.
Yes.
They drive the property values through the roof, even though hardly any houses are actually changing hands.
That is exactly what happens in the order books. The buyers who want in on this Chinese hardware ban narrative, they have to bid the stock higher and higher just to convince anyone, to part with their shares.
That makes perfect sense.
And when you factor in the stock's beta, the velocity of that squeeze makes even more sense. The stock carries a beta of 3.87.
Okay, for anyone who doesn't live and breathe volatility metrics, a beta of 1 means the stock moves exactly in tandem with the broader market. So if the S&P 500 goes up 1%, the stock goes up 1%.
Right.
So a beta of nearly 4 means this thing is incredibly sensitive.
It acts like a coiled spring. I mean, if the broader market experiences a slight pullback, this stock is mathematically prone to a severe drop.
It crashes hard.
It does.
Yeah.
But when it catches a strong macroeconomic tailwind, like a proposed ban on foreign competitors, the stock goes into orbit.
So extreme historical volatility multiplied by a geopolitical catalyst divided by a total lack of sellers results in a violent 72% upward move on below average volume.
That's the formula right there.
And if you look to the corporate insiders for clarity on whether this price is justified, the data, honestly, only deepens the confusion.
Wow, the insider data is fascinating.
It is. Over the past 90 days, insiders at Applied Optoelectronics have bought a net positive of 648,122 shares.
Which is a huge number.
At first glance, that looks incredibly bullish, right? The people actually running the company are buying their own stock. But when you dissect the individual transactions, Those massive net shares were driven by just 14 concentrated buy orders compared to 54 separate sell transactions.
It creates a really fascinating psychological puzzle because on one hand, you have a few individuals taking massive, high-conviction positions.
Right, it's like the captain of the ship doubling down, buying up equity because they know the Perlin factory expansion is going to work.
Exactly. But on the other hand, you have 54 separate instances of insiders taking chips off the table.
Which is a lot of people cashing out.
It is. You could argue that while the captain is buying, a large portion of the crew is quietly heading for the lifeboats, cashing out because maybe they see the Lumentum threat or the indium phosphide yield issues up close.
It is a highly conflicting signal that basically prevents us from drawing a clean, unified conclusion that management uniformly believes the stock is undervalued.
It really does muddy the waters.
Which perfectly tees up the ultimate debate of this deep dive. Bringing the physical laser bottlenecks, the intense EML competition, the geopolitical heights, and the wild liquidity squeeze all together. We have to confront the valuation.
The big number.
Right now, the market is valuing Applied Optoelectronics at a $10.3 billion market cap.
That is a staggering weight for a company in this specific financial transition. I mean, if we lay out the bear case, the very real risks of that valuation, a $10.3 billion market cap gives them a price-to-sales ratio of 20.35.
Just to pause on that, investors are paying over $20 for every one single dollar of sales the company makes. Not profit, just top-line sales.
Yeah.
And we already established that trailing net margins are sitting in negative territory. I mean, a typical manufacturing company might trade at 2 or 3 times sales. 20 times sales is like a purely software level valuation.
And a valuation that elevated means the stock is currently priced for absolute perfection.
Meaning there is no room for error.
None. The market is blindly assuming that Applied Optoelectronics will flawlessly execute their Perlin manufacturing expansion without a single delay. It assumes they will completely resolve the indium phosphide bottleneck and that revenue will continue accelerating at 64% without skipping a beat.
And the market is entirely unforgiving if that perfection isn't met. If revenue growth decelerates even slightly, or if Lumentum successfully steals a meaningful chunk of market share with their EML transceivers, the downside repricing will be severe.
We just saw this exact stock suffer a 28% drop over a 13-week period recently.
Exactly. When you are priced for perfection, the slightest imperfection triggers a massive institutional sell-off.
However, the bull case demands equal attention here, because if they actually pull this off, the upside fundamentally alters the company trajectory.
What does that upside look like?
Well, their forward-looking guidance for Q1 of 2026 targets gross margins of 29 to 31%. If the new Texas facility ramps up smoothly, if they can produce these lasers at scale, and if hyperscalers are legislatively forced to buy domestically, they could easily reclaim that previous $150 to $160 price level.
Wow. So transitioning from non-GAAP profitability to sustained, unquestionable GAAP profitability would solidify this as one of the most monumental turnaround stories in the entire infrastructure space.
It absolutely would. It is a high-wire act of genuine top-line growth colliding with intense physical execution risk.
So what does this all mean for you? If you are tracking this sector, you cannot just stare at a wild stock chart waiting for a breakout. You need to know what fundamental forces are driving it, what specific early signals would prove to us that the company is actually surviving this high-wire act.
You want to look for 2 concrete confirmations. First, financially, you need to look ahead to the Q3 2026 earnings release, which should drop around November.
Okay, what are we looking for in November?
Top-line revenue growth is great, but the critical signal will be positive GAAP earnings per share. You want to see those gross margins physically expanding above that 31% threshold. That proves the business model scales profitably without relying on accounting adjustments.
Right, no more non-GAAP magic.
Mm-hmm.
And mechanically, we need to know if the factory is actually working.
Precisely. The second signal is definitive public confirmation regarding the laser supply bottleneck.
What does that sound like?
You need to hear management explicitly state on an earnings call that the Perlin capacity milestones are being met, that the 800G and 1.6T manufacturing lines are fully operational, and that the indium phosphide bottleneck has officially eased. Until they publicly confirm that physical constraint is lifted, that revenue ceiling remains firmly in place.
It is a high-stakes, high-beta collision. On one side, you have the practically infinite, insatiable demand of the AI revolution.
Unstoppable demand.
And on the other side, you have the very real, very stubborn physical limits of semiconductor manufacturing. Applied optoelectronics is caught directly in the center of that impact zone. You look at that wild stock chart, that broken EKG machine of 493% gains and 50% drops, and it looks like pure digital chaos.
It really does.
But underneath all that market noise, the heartbeat of this company, and maybe the heartbeat of the entire AI boom itself, comes down to something as fragile as manufacturing a physical optic nerve.
Which leaves us with a rather profound reality to consider. We constantly obsess over AI as a purely digital revolution.
Oh, definitely.
Software living in the cloud, algorithmic breakthroughs, infinite pools of weightless data. But this specific bottleneck proves that the digital revolution is entirely captive to the physical earth.
It has to exist in the real world somewhere.
Exactly. The ultimate ceiling on artificial intelligence isn't going to be writing better code. It's going to be the geopolitical battle for raw materials. The energy grid required to power these massive manufacturing hubs in Texas, and our finite ability to physically mine and refine complex elements like
It's
indium.
a sobering thought.
It is. When the infinite demand of a digital mine crashes into the finite resources of the physical planet, that is where the true paradigm shift will happen.